The bank's kicking off earnings season in just over 12 hours from now. JP Morgan and BlackRock on deck tomorrow. Goldman Sachs, Citigroup, Morgan Stanley hit the tape on Thursday. Financials lower today. Wells Fargo and JP Morgan among the biggest losers, and the losses may be about to widen. Our next guest warns the wild moves in commodities could lead to some downside surprises in the sector. Let's bring in Gerard Cassidy, head of U.S. Bank Equity Strategy for RBC Capital Markets. Gerard, great to have you with us. A lot of the banks have already disclosed what their Russia exposure is. And we know, for instance, that J.P. Morgan was a counterparty to that big nickel trade gone wrong by the Chinese tycoon. So what more is there that has not been disclosed? Because I would think that the banks would probably disclose the biggies at least.
No, you're right, Melissa. Thank you for having me on the show. And I would add that it was the volatility in the first quarter in fixed income, particularly in the rates market, which is government bond trading, as well as the commodities. And we don't know the full extent. We will tomorrow, of course, when JP Morgan announces its numbers. We also have to remember this counterparty risk here. There could be smaller companies or trading firms that may have had trouble that just hasn't been announced yet. But you did announce the big one, and JP Morgan is rumored to be the big risk there.
Gerard, let's talk about the two numbers I think are most important. Just my view. Net interest margin for JPM, probably around 1.67. But the biggie to me is what you're willing to pay as a multiple of tangible book, which will come in around $72.50. I think the low end is sort of 1.7, which makes it a $125 stock. We've seen it north of 2. How do you look at that in this environment where valuations are getting ratcheted down?
No, you're absolutely right, Guy. When you take a look at the net interest margin, that is the story for 2022. Now, granted, the capital markets businesses for all these companies are going to really have tough numbers in the first quarter. But if the Fed follows through with raising Fed fund rates to upwards to 2% by the end of the year, net interest margins for the group will expand very meaningfully, bringing a considerable amount of revenue to the bottom line. And I think as investors focus in on that, that will benefit the valuations that you just described. Investors are looking through that benefit, and they're all focused on a recession, which we don't see happening this year, which of course would raise credit costs. And that's why I think the stocks are underperforming in these last 2 weeks.
Gerard, you say, according to my notes, that you see the most potential trouble in Citi, which is no surprise given that it's sitting basically at 52-week lows, and Morgan Stanley, which did surprise me given their mix of business. Why Morgan Stanley?
Melissa, what's interesting is going to be what's happening to the asset management and wealth management businesses. We all know about what's happening in the institutional capital markets business. But we have to remember, with down markets, many of the revenues generated from these companies are tied to the market values. And think about bond values. Think about retail investors having losses in their bond ETFs or mutual funds, and we haven't seen losses in those funds for years or for many quarters. So I think what you're going to see is just less than expected revenue growth in these more annuity-like revenues, which are not as predictable as in a down market as they are in an up market.
Gerard, thanks for coming on. Good to see you. Gerard Cassidy of RBC. Where do you stand on the banks, BK?
I think they're troubled. They're getting hit on so many different areas. I mean, not only is fintech trying to come and eat their lunch, but then think about what's going on out there. You've got commodity houses that they're exposed to that they're not going to be able to make those loans to. They've got consumer issues that they may have problems with if you get a recession. So there's so many problems here with the banks. And the biggest tell for me is that the yield curve got steeper and banks didn't go up. That's the environment they should go up in, or should be. That's what Gerard's talking about, and they didn't. So to me, they seem challenged.
Guy, I thought of you this morning, and that's not necessarily unusual, but in this context, and that is that the U.S. investment firm Capital Group sold their stakes of Deutsche Bank and Commerzbank, which they added to during the pandemic. They had 5% stakes, and they offloaded them. And I immediately thought of you.
Are you sure that was banks? I mean, that's a good excuse as any, I guess. I understand. No. Listen, you know my view on Deutsche Bank. You know, one of the biggest derivatives books in the history of mankind, and I think that's just a powder keg waiting to happen. But I think the ancillary, the tangential play is in the form of Citibank. You know, Citibank is one step removed from what's going on with Deutsche and Commerzbank. And I think BK brings up a good point. These banks are challenged without question, and Citi trading at 72% of tangible book illustrates exactly that. So when people are paring down bank exposure in this environment, I think you have to take notice. And if credit starts being a concern, and I've mentioned it a number of times in the form of HYG, again, I don't know who Katie is, but she better bar that door.
Bonawyn might know where she is. Bonawyn, you're concerned about the consumer accessing credit.
Certainly. I mean, well, they've already reached out to access credit, which is already adding, balance sheet or leverage to their balance sheet that may or may not have been tapped yet. Juxtapose that with institutional issuance, which was actually low in the first quarter, and you probably won't see the same type of fee generation, which is what I think the other panelists are getting to. I also noticed that Cassidy called for a rotation or a preference for regional versus these large trading houses, which definitely does not bode well either. I think the sentiment has gotten quite negative, so there may be a bit of a reversal here. But, unless the trading and the M&A fees are what you're essentially paying for the JP Morgans, the Goldmans, the Morgan Stanleys over, the members of the regional KBW or KRE type of index. So I don't think that really sets up well. With that said, the sentiment has gotten pretty negative. These are all trading at multi-week, multi-month lows. So, any positive news, and I think you might see a bit of a reversal there.
Yeah, I think that's a great point. Bonawyn, the sentiment is so bad, and these stocks have underperformed so dramatically, even when the stock market was rallying just a couple weeks ago. And I'll just say this, that JP Morgan, you're going to know, when they reported their Q4 back in January, it was down 6% the next day. That was a huge gap lower and close lower, and the stock continued to go. If the stock has a relief bounce, and the whole group, let's say, bounces, but the quality is not great, and the visibility and the guidance is poor, I'm just telling you this, the at-the-money puts 1 month out in the XLF, that would be making a bet that the XLF goes lower. If you were to buy those between now and then, costs you 3%. 3% when you think about just the risk that might be encapsulated in those. So I think the options market be underpricing the risk, kind of saying that sentiment's bad, and we don't think there's an immediate gap lower, but maybe you have the opportunity after JP Morgan's results.